All right. I restarted my PPT. Okay. So when company buy back its shares from the market, we call this treasury stock. So what is treasury stock? So issued shares reacquired by the company. So now you understand the difference between issued and outstanding capital, outstanding common stock and issued common stock. Issued common stock means how many shares are being issued to the shareholders. For example, we talk about 1 billion. 1 billion is equal to 1000 million, right? And company buyback 100 million. So it means in the market right now there are 900 million shares. So that's called outstanding share. So 100 million that company reacquired from the market is called treasury stock. So treasury stocks are the company's own stock that company buy back from the market. What are the reasons? The reasons are make shares available for employees because companies has contracted with the employees. If profit increase, we will give you this much amount of shares. So company buy back from the market and give it to the employees. And then plan to buy low and sell high. Company can also profit from its own shares. So when company buy back its own shares, demand of shares rises because company is buying back its shares. Outstanding share rises, right? In that case, company thinks itself that right now the market value of our stock is not good. In future, it's gonna increase, so we buy back our shares, right? Plus, to avoid takeover, if somebody in the market is buying the shares so that he can gain control of the firm, we call this hostile takeover. So in order to avoid the hostile takeover, company buy back its shares so that company management has the 51% share in the share of the company, not somebody else. Plus increase the earning per share. If number of shares decreases from the market, earnings per share. If shares decreases, then earnings per share ratio also increases. Plus use a share repurchase program. Company can also in order to maintain its individuality, its control, its board of directors control, company can issue a repurchase program so that company can buy back its shares from the market. So what are the reasons here? Okay, how is a treasury stock recorded? So they are recorded at cost. There is no par value in case of treasury stock, and plus the treasury stock balance is debit balance, which is the contra account for common stock or equity account. For example, company repurchased 74 million shares for $4 billion. So what will be the entry? Simple. Company pay the cash, cash decrease, credit 4 billion, treasury stock increase 4 billion. So there is no par value. Why? Because company did not buy back at par value. Company buy back at its market value. So treasury stock balance is the debit balance, which is the contra account of our common stock account. Guys, you understand? Oliver, Faik, Nana,
Yes.
Arun, good. So you see how we are going to write it down? Simple common stock, paid in capital, retained earnings, treasury stocks. So you see treasury stocks for return on bracket negative because when treasury stock increases, the stocks decreases, equity decreases. So we write it down as negative here. So retirement of treasury stock. If you want that we our stocks in the market should be decreased. We should many stocks now we are canceling it. So it means we will be making an making a reverse entry here. So what would be the entry then? We will call it as retirement of treasury stock, which means we are canceling the certificates of common stock. All right, we simple. Once shares are repurchased, neither total assets nor the total liabilities are affected. Why is that? Because assets at the end must be equal to liabilities plus owner's equity. If owner equity is now decreased, assets is also decreased. All right. So equation must be balanced. So plus when you are cancelling the stock certificate, you must need a memorandum entry. I hope we would have here. Do we have here? Let's see. Okay, I think no. Just the memorandum entry, which means the one-time entry to cancel the number of stocks. So entry gonna be common stock to treasury stock. In that case, common stock decreases mean on debit side, treasury stock decreases on credit side. So this is a contra account. When treasury stock increases, debit. When treasury stock decreases, credit. So memorandum entry gonna be common stock to treasury stock. And this does not affect the accounting equation. Why? Because common stock decreases and also treasury stock also decreases. So decreases mean positive balance, increases mean negative balance. So here negative and positive cancel each other. So there is nothing happen to this equation. Now the resale of treasury stocks. What if company resell in the market? So when we have a gain or loss, I think we have here. Yes, let's understand it through an example. The example is, let me, yeah, here. So on July 22, 2014, Home Depot resold a million shares of treasury stock 55 per share, assuming that average cost of the treasury stock was 54.05. All right. So it means their purchase price was 54.05 and now they have sold it for 55. How much they have received? 55 into a million, 55 million. Cash received 55 million. Treasury stock decreased by the amount 54.05 million. The difference is called premium and premium is called paid in capital, and this paid in capital on treasury stock. Simple. Paid in capital from treasury stock. That's it. Guys, you understand this entry? So can we resell our stocks on premium? Yes. On increased value? Yes. If on decreased value, then the paid in capital will be on the debit side as a discount. Then the entry gonna be cash to discount from treasury stock to treasury stock. Alright? So this is the illustration. So let's do that together. At December 31st, 2014, Hardnet Corporation reported the following equities of shareholders as well. So we have common stock 1.50 par value, 2400 million shares issued. So we have 3600 million in millions. So value of 2400 million shares are 3600 million. Paid in capital in excess of par of the common 7200 million. Retained earning 490 and treasury stock 85. So we purchased from the market $85 million worth of shares. All right. So let's just talk about here. Hornet 2015 transaction included issuance of 16 million stocks at 10. So what is the par value? Minus 1.5. So they receive 8.5 premium. So entry gonna be cash received 16 million into 10, 160 million, common stock 24 million, and paid in common stock 136 million. B. Purchase 6 million shares treasury stocks for 100 million. Purchase back. So entry gonna be treasury stock to cash. Treasury stock to cash. So they purchase of 6 million stock for 100 million. And they sell 3 million of treasury stock purchase in part B for 70 million. What is part B? For 70 million. So here, so they purchase 6 million stock for 100 million, right? And half of the stock they sold it for 3 million, they sold it for 70 million, right? So half of the stock originally cost you 6 million stock for 100 million, which means 3 million stock for 50 million, and they sold it for 70 million. So it means they must have some kind of gain. All right. So first of all, in part B, 6 million shares for